You found the house, you're pre-approved, you're ready to make an offer. Not so fast. Before you sign anything, before you put down earnest money, before you even call your realtor, there are 8 things you need to check. 8 things that can add hundreds of dollars to your monthly payment. 8 things that can make a home uninsurable when you are 3 weeks away from closing. 8 things that separate a prepared home buyer from a buyer who gets blindsided at the worst possible moment. I've made this checklist because I have seen it happen too many times. Buyers who get to closing and discover their insurance premium is double what they expected. Buyers who find out the roof is uninsurable. Buyers who did not know they needed flood insurance until the lender requested it 3 days before closing. Save this video, screenshot it, send it to your agent. These 8 checks can save you thousands. Let's go through them one by one. Number 1, get an insurance quote before you make an offer. I cannot stress this enough. Do not wait until you're under contract. Do not wait until your lender asks for it. Do not wait until the week before closing. Number 2, check the property's claims history. There's a report called a CLUE report that stands for Comprehensive Loss Underwriting Exchange. It is the insurance industry's record of every claim filed on a specific property. And here is why it matters. Insurance companies price your premium based partially on the claims history of the home you are looking at buying, not just your personal history. So if the previous owner filed 3 hail claims in 5 years, your premium will be higher. If there was a major water damage claim, some carriers may refuse to write the policy at all. The seller's disclosures may tell you about past issues, but it does not give you the full picture. The CLUE report shows you exactly what the insurance company sees when they evaluate the property. Now, you can request a CLUE report through your insurance agent. If the seller has a current policy, they can also request a copy of their own CLUE report and share it with you. So what should you be looking for? Hail claims, especially multiple hail claims. Water damage claims, which can indicate ongoing issues. Roof claims, which tell you the roof may already be compromised. And frequency. Multiple claims in a short period is a red flag that the property is in a high-risk area. Even a claim that was filed and denied shows up on the report. The mere act of filing affects the property's insurance profile. So, if the CLUE report shows multiple claims, it does not necessarily mean you should walk away, but it does mean you need to get an insurance quote. Number 3, verify the flood zone status. This is the one that catches buyers completely off guard. Standard homeowner insurance does not cover flood damage, not a drop. If your home floods and you do not have a separate flood insurance policy, you are paying for the repairs out of your own pocket. If the property is in a FEMA designated flood zone, specifically Zone A or Zone V, your lender will require you to carry flood insurance. That is a separate policy on top of your homeowner insurance, and it can add hundreds of dollars per month to your monthly payment. Here's what you need to do. Go to the FEMA Flood Map Service Center. Enter the property address that you're interested in buying. The map will show you the flood zone designation for that specific location. But here's something most people don't realize. Flood zones change. A property that was not in a flood zone 5 years ago may be in one now. FEMA updates these maps regularly based on new data, changed drainage patterns, and updated models. Even if the property is not in a designated flood zone, consider flood insurance if the area is low-lying. If you're in Zone A or Zone V, budget for flood insurance and get a quote alongside your homeowner's quote. If you're outside those zones, but in a flood-prone area, talk to your agent about a preferred risk policy, which is much cheaper, but still gives you coverage. Number 4, check the roof age and condition. Insurance companies care deeply about the age and condition of the roof, and it directly affects whether they will insure the home and at what price. So here's the rule of thumb. A roof older than 15 to 20 years old may not be insurable with standard carriers. Some carriers will not write a new policy on a home with a roof over 20 years old, period. Others will insure it, but only on an actual cash value basis, known as the ACV, instead of full replacement costs. And the difference between those two is enormous. Replacement cost means if your roof is destroyed, the insurance company pays to put a brand new roof on your home. Whatever the cost, that's what you want. Actual cash value means that the insurance company pays what your old roof is worth, depreciated for age. A 20-year-old roof that originally cost $15,000 might only be worth $2,000 today under AC coverage. You get $2,000 and you pay the other $13,000 out of pocket for the new roof. This is how people end up with a $30,000 bill after a hailstorm. They thought they had coverage. They did, but it was actual cash value, not replacement cost. So what should you do? Ask the seller, how old is the roof? When was it last replaced? Is there a warranty? Get the documentation, not just their word. Then ask your insurance agent, will this roof qualify for replacement cost coverage? Or will I get actual cash value? And request a roof inspection during your option period. Do not skip this. A roof inspector can spot hail damage, missing shingles, and structural issues that are not visible from the ground. Some insurers also require a 4-point inspection before issuing coverage on older homes. This covers the roof, electric, plumbing, and HVAC. Ask your agent if this applies to the property you're considering buying. Number 5, compare the full PITI payment. That's the PITI, not just the loan payment. I covered this in detail in video number 1, but it deserves its own spot on this checklist because it is the most common mistake I see. Two homes with the exact same purchase price can have completely different monthly payments. Why? Because property tax rates vary by county, parish, township, city, and school district. Insurance costs vary by zip codes, and HOAs, homeowner association dues, vary by neighborhoods. For every property you are seriously considering buying, ask your lender for a full PITI estimate, principal, interest, tax, and insurance estimate, not just the principal and interest. Give them the property address so they can pull property tax records from the appropriate appraisal district. That gives you a more accurate tax estimate than using a generic rate. Then combine it with the insurance quote that you got. Now you have your real monthly payment for that specific property. Do this for every house you are comparing. The purchase price tells you what you're buying. The PITI tells you what you are paying. Always compare PITI to PITI, never price to price. Number 6, ask about windstorm and hail coverage. Most standard homeowner policies cover wind and hail damage, but the details vary, and the details are where the costs hide. If you're buying near the coast, generally in the Tier 1 or Tier 2 coastal areas, you may need separate windstorm coverage. Ask your agent, does this policy cover wind and hail damage? Is there a separate deductible from wind and hail? And if I'm in a coastal area, do I need coverage for that also? Number 7, understand your deductible structure. This is the item that costs people the most money when they actually need to file a claim, because they did not understand their deductible until it was too late. There are 2 types of deductibles you need to know about. The first is a flat dollar deductible. This is simple. It might be $1,000 or $2,500. You pay that amount and the insurance company covers the rest of the claim. Easy to understand. The second is a percentage deductible, and this is where people get in trouble. Ask your insurance agent these 3 questions. What is my deductible for each type of claim? Standard and wind and hail. Is it a dollar amount or a percentage? And what would I pay out of pocket if my roof was damaged by hail? Know the answer to the last question before you need to file a claim, not after. Higher deductibles mean lower premiums. That can be a smart trade-off if you have savings to cover the out-of-pocket costs. But if you are stretching to afford the home, a high deductible can be devastating when a storm hits and you don't have the $8,000 in the bank. Number 8, budget for an annual escrow increase. This is the thing that catches people in year 2 and 3. Not at closing, but later, when they think their payment is locked in. Here is the reality. Even with a 30-year fixed rate mortgage, your monthly payment can increase every single year because your payment includes property taxes and insurance through your escrow account, and those costs are not fixed. Your servicer conducts what is called an annual escrow analysis. Once a year, they review your escrow account. They look at what they collected versus what they actually paid for taxes and insurance. If there's a shortage because your insurance premiums went up or your property taxes increased, they raise your monthly payment to cover the difference. So here's a practical tip. If your lender sends you an escrow refund, which happens when there is a surplus in your escrow account, don't spend it. Set it aside, because the following year, you may get a shortage letter instead. Having that buffer prevents payment shock. The rule is simple. If you're house poor from day one, you have no buffer for the increases that will come. Buy a house that you can afford, and when the payment goes up by 10% in 3 years, you'll be able to handle it. So let me put this entire series together for you. In video 1, I showed you that your mortgage payment is not just the principal and interest. It's the principal, interest, taxes, and insurance, also known as your PITI payment, P-I-T-I. In video 2, I explained mortgage insurance. If you're putting less than 20% down, you are paying a second insurance cost every month. On FHA loans, it's called MIP, or mortgage insurance premiums. On conventional, it's called PMI, or private mortgage insurance. Choose based on your credit score and know when it goes away. And in this video, I gave you an 8-point checklist. Number 1, get an insurance quote before you make an offer. Number 2, check the property's claim history with a clue report. Number 3, verify flood zone status at the FEMA website. Number 4, check the roof age and condition. Know whether you have a replacement cost or actual cash value coverage. Number 5, compare the full PITI payment, not just the loan payment. Number 6, ask about windstorm and hail coverage. Know if you need additional coverage. Number 7, understand your deductible structure. Know what you would pay out of pocket before a storm hits. Number 8, budget for annual escrow increases. Plan for 3 to 5% yearly increases in your insurance and tax escrow. If you go through this checklist on every property you consider buying, you'll be more prepared than 90% of buyers. You'll know what your insurance costs are, you'll know what your deductibles are, and you will not get blindsided at closing. That's your 8-point checklist. 8 things that separate a prepared buyer from a surprise one. And that wraps up our 3-part series on the real cost of buying a home. Let me recap the whole thing for you in 30 seconds. Your mortgage payment is made up of your principal, interest, tax, and insurance, not just principal and interest. Insurance and taxes can add over $1,000 a month to your monthly payment. These costs are rising every year. If you're putting less than 20% down, you are paying mortgage insurance on top of homeowner's insurance. Know the difference between FHA, MIP, and conventional PMI. It can save you hundreds of dollars a month. And before you make an offer on any home, run through the 8-point checklist. Every single item. Don't take any shortcuts. If you watched all 3 of these videos in this series, you are now more prepared than the vast majority of buyers out there. You know what your real number is. You understand every component of it, and you have a checklist to protect yourself. There's a free cheat sheet in the link of the description below. It summarizes the entire series on 1 page. Print it, take it with you to open houses. Send it to your agent. It's yours. Hit the subscribe button for more homebuyer education content like this. I post every week breaking down mortgages and real estate topics with no jargon, just real information you actually can use. Remember, on this channel, we simplify the home loan process. And if this series helped you, share it with someone who is buying a home. They'll thank you for it later. Let's be good to one another. Let us let grace abound. Continue watching these videos. to help you in your education, and more importantly, you guys stay blessed. Indeed.